Good morning and welcome back to Financial Issues. My name's Dan Celia here in the Philadelphia area where we're supposed to get another 6 to 8 inches. My word. Thankfully, we are in a time of global warming, or who knows how much snow we would have gotten this year. So, but anyway, another storm coming in. So this is crazy. I'm ready to, I gotta move. I'm just, it's the whole shoveling thing and snow blowing and all that stuff's just getting so old. 866-300-9298. That's our phone lines. If you want to queue your call up, you're welcome to do that. But we're going to talk a little bit about some economic news here this morning. Yesterday, of course, the Dow closed down 326. Huge dip in the Dow. It's all about the weather. It's just bad weather. It's nothing more than bad weather. So that's why I brought up that weather situation. I mean, if this keeps up, you know, man, who knows what the Dow could do if this bad weather keeps up. But anyway, bad weather, Dow's down 326. They are saying the ISM report has something to do with it, automotives and those kinds of things. But of course, all of that was based on bad weather. It's the reason why ISM numbers were down. The fact of the matter is ISM numbers are down because they're working through an exorbitant amount of inventory that they had from December. If you remember, the durable good orders and the ISM number in December looked very good. It was a big jump up. And the reason for that was all the inventory. So right now they're working through that inventory. That's got a lot to do with it, probably more to do with it than anything else. So we'll have to just continue to try to put out the truth about that. But trust me, folks, it's not about weather. Hey, listen, I sent out on my Twitter page, on Twitter this morning, I guess it's on my Facebook page as well, Facebook/Financial Issues. My Twitter is @Financial Issues. Mutiny on the USS America. Mutiny on the USS America. It's a very brief article that Alan West wrote, Colonel Alan West. So take a look at that. I'm not going to go into the detail. I'm not going to read it. Great stuff, though, from, I hope someday he'll be a presidential candidate, Alan West wrote. So good stuff. It's called Mutiny on the USS America. And he is talking about, of course, some of the things that came out in reference to the State of the Union. So good stuff. Make sure you pick that up. Stock futures point to a little bit of a rebound here this morning. Rebounding from yesterday's, of course, sharp losses. December factory outlook data. The Federal Reserve is speaking today. That's on tap. So we'll have to watch that. But the sell-off spurred mostly because of weaker than expected manufacturing data, both here and the concerns about the slowdown in China. That's what most of the reports are citing. That may be true. And China is in a much bigger or worse situation than certainly we are here in America. And we continue to see issues, some people actually talking about job creation. Can you imagine? We are talking about job creation here in America as a key issue. It's about time, and we are doing nothing about it, by the way. But, you know, I've said this before about China. China wakes up every morning, and they wonder if they're going to create 28 million jobs this year in order to kind of keep back any kind of revolt in their society. So think about this, waking up every morning knowing that this is the year you've got to create 28 million jobs, and we see their manufacturing output decrease as it did all across Asia. Japanese stock market down 14% last year. Japan, the Japanese index, Japan, was the highest growth, I think it was 56% of all the economies globally, had an incredible year. There were people saying last year about Japan, hey, it's not a big deal. It's still got upside potential because remember, it hasn't budged in 14 years. So this is nothing. It's got a lot of ground to make up. Well, it did make up the ground. That ground is now gone. It's down 14% today. And they also have manufacturing output slowing down. That's a big deal for Japan because keep in mind, folks, Japan economy is dependent upon exports. That's what they do. They manufacture stuff and they export it. So I wonder if that's going to have any impact on today's markets. But right now, everything looks like it's going to open slightly positive. Gold had a good day yesterday, but it's giving back some of those gains right now as the dollar apparently is strengthening. Prices of goods in Europe and factory orders rose in December. So that's probably a good thing because Europe, coming off of this idea of some concern about their deflationary issues, so they're seeing a little bit of increase in a producer price index going up a little bit, and that's probably some good news for Europe. It's a very, very fragile economy, and there are many people writing about that this morning and talking about the fragile economies of Europe. And, you know, they're concerned about deflation, and they've got to be very concerned about inflation inflation going up. That's got to be a huge concern, and somehow they have to perfectly fit in the middle. Because their economy is so fragile, there's not a lot of room for error. I believe that the U.S. economy is very similar, extremely fragile. And, of course, the job numbers in the U.S. economy are going to be the big number this week, and that's coming out on Friday. We have not had any real job creation. I don't expect any. I don't believe this president wants any. But we're not going to have 43% of all the jobs created, by the way, since this recovery has started. 43% of all the jobs created make less than $16 an hour, 43% of them. Almost 80% of them are part-time jobs. 80% of all the jobs created are part-time. That's why the average work week still hangs around at 34 hours per week. So the other problem with the job market, and we keep talking about the manufacturing sector and how well it's doing, I hear over and over again about this incredible recovery in manufacturing. Really? Do you know out of the 316 million people in America, only 8% of those that are working, 8% are actually making something? Making something. Where's all the other stuff coming from? Well, it's not coming from America. Yes, there is desire to change that and move that up, but these are the kinds of things that we don't hear about when it comes to talking about our so-called recovery. 866-300-9298. Chief executives across the country apparently, according to a new index, it's called the Young, not young as in youth, but Young Presidents organizations. They are. It is this Young's Index takes surveys CEOs to get an idea of sentiment, and the index climbed to 63.5% from 60.5%. Anything below 50 is considered to be a negative sentiment. So it looks like it's growing, and they are a little bit more positive than they are negative. And they are looking at sectors of the economy this year. They're looking to see a recovery in housing, consumer spending, investment, trade, and government spending. Just what we need, a recovery in government spending. They're looking to see increases in those areas, and they're expecting a better outlook. They may be right. With the exception of consumer spending, I don't see any of that happening. I want to know how the Federal Reserve can create the kind of wealth effect that they have created, and then anybody expecting to see consumer spending when it hasn't happened with all this wealth that has been created with the heated up, overenthusiastic, false positive of the economies. And consumer spending goes a long way, obviously, like 71% of the way to seeing a thriving economy. There's a lot of people talking about emerging markets, that we are either ignoring emerging markets or we're not paying enough attention to emerging markets and how good they are doing. Emerging markets right now are seeing a sell-off. They have been seeing a sell-off. Global investors have pulled $6.3 billion out of emerging markets. Now, maybe you could make a case that that's overdone. Maybe it is. But the fact of the matter is, it's been done. And it says something about the confidence globally about emerging markets. Emerging markets dependent upon quantitative easing, believe it or not, dependent upon that easy, cheap money flowing into companies, flowing into emerging markets. It is dependent upon China's growth, China's manufacturing. So that's slowing. It's dependent upon emerging markets are impacted a little bit greater than some of the larger developed economies as far as currency goes. So we see the weakness in currencies in Turkey and South Africa, other countries, that is causing some concern in emerging markets. I bring that up because there may be a buying opportunity in emerging markets. I don't have a lot of emerging markets on my list except for Timothy Fund's emerging markets, which is, by the way, is not on my buy list right now. But it could be soon. We'll be watching that. I also, if you're a partner with me on the website, you see an alert I sent out. I sent out an alert yesterday talking about what I think about this economy, asking people don't get sucked into this whole idea that it's just bad weather. And what I did was I reiterated a call that I made in late December and early in January, both in writing and on this radio program almost every day towards the last week of December and the first week of January, saying this is the time to take profits. Many of you did that. Good for you. You're sitting on the sidelines with a considerable amount of cash, I would hope, headed into this. If you didn't take heed, you might want to consider it. You had some great gains last year, I would hope. Let's see and this is primarily, my primary concern are those people that are nearing retirement, that are 6-7 years away from retirement or sooner, or in fact are already retired. You better consider, I'm not making a case. So I got several emails from my partners after I sent out the alert saying, should I sell everything? No, I didn't say that. And if it sounded like I said that, then I miswrote it because it's not what I wanted to sound like. What I wanted to say is, and I'm pretty sure I said this, it's time to have a considerable amount of money on the sidelines. I said that in December, but I'm reiterating it. I am not reacting to the negative day yesterday. The negative day yesterday was a reminder of what I had said over a month ago. I'm just hoping everybody paid attention. We're seeing market yields go down. Why is that a concern? It's a concern because 10-year bond yields go down. It is a concern because it is indicating another flight, a flight out of equities and a flight into so-called safety. And that's why the yield is coming down on the 10-year. Another very interesting note about yesterday's market is there was very high trading, very high volume, not only on the retail side, not only just in equities, but there was an enormous amount of selling in ETFs, fund managers, hedge fund managers. Something to think about. I know you've got a lot of questions. We're going to get to those. 866-300-9298. We'll be right back after this.